A price cap on Russian oil was a major discussion point at the G20 summit. However, the United States and the European Union failed to convince the group's members to join the initiative as they considered the idea unpromising. This somewhat calmed markets and oil prices even advanced. However, other fundamental factors continued to put pressure on the asset. Geopolitical tensions are mounting, which forces oil traders to assess the risks of reduced Russian energy supplies to Eastern Europe. On Tuesday, oil supply via the Druzhba pipeline was suspended due to renewed shelling in the territory of Ukraine, which cut off power supply. In addition, fears of further supply disruptions were fueled by an incident involving a commercial vessel off the coast of Oman. According to the Associated Press, a Liberian-flagged oil tanker operated by Singapore-based Eastern Pacific Shipping was struck in an exploding drone attack of the Gulf of Oman. Against this backdrop, oil prices are trying to stabilize around $94 per barrel. However, the market is in a nervous mode, thus the quotes may either jump to $100 per barrel or collapse below $90. From a technical point of view, given its past behavior around the level of 92, the price may well again approach the control level of 92. Gold continues to hold steady above $1,770 per troy ounce, just below a 3-month high. This is largely due to the dollar's sideways move. Gold futures slowed down at the pace of the upward cycle around the $1,785 mark, thus forming a range limited by the levels of $1,765 and $1,785. The current halt could well serve as an accumulation process, foreshadowing new price swings. Thus, the best tactic is to trade range breakouts. Investors are indecisive when trying to predict the Fed's further steps. They are still wondering whether the US Central Bank will slow down the pace of the interest rate hikes or not. In the meantime, market participants are ready to speculate on the actions of the Bank of England. Today's data on the UK inflation suggests that the British regulator will most likely deliver 75 basis point interest rate hikes, at least at the next two meetings. This means that investors will keep fleeing from safe haven assets to government bonds. So the medium-term outlook for gold is rather gloomy. In the best-case scenario, the yellow metal will dip below $1,700 per troy ounce by the end of the year. Another factor affecting gold is fears about a wider geopolitical conflict in Europe. After all, tensions in the region rose following the news on missiles hitting Polish territory. Although many countries, including the United States, said that Russia was not responsible for it, risks in Europe somewhat increased. This, in turn, has a negative impact on the ruble. The dollar fell below 60 rubles, but then returned above that mark. The ruble was supported by the outcome of the G20 meeting. It became known that the United States and the European Union failed to push other countries for a price cap on Russian energy. In the light of the new events, the dollar-ruble pair is unlikely to fall below 60 rubles per dollar. The market will probably spend the coming days stabilizing, thus remaining at current levels until the end of the week. And that's all for now. We wish you a profitable deal. See you on our channel with a new video in a couple of hours.